Hello, and welcome to the fifth and final installment of the Personal Finance webinar series brought to you by Dowling and Yahnke. My name is Jeff Gosler, and I'm going to be running through the presentation. I have been with the firm for about 13 years, and my position is a portfolio management analyst. I have my Chartered Financial Analyst designation, and a little bit about the firm. We're a registered investment advisor. We manage about $4 billion worth of client assets for over 1,200 individuals, families, and charities. I have my colleague Arya Kromvita with me today. She's going to be running things in the background. I'll let her say hi to you right now.
Thanks, Jeff. Hey guys, my name is Arya Kromvita and I'm a lead advisor with Dowling Yahnke. As a lead advisor, I work directly with our clients on investment management and financial planning throughout all stages of their lives. A little bit about me. I grew up in Scottsdale, Arizona, and I graduated from Claremont McKenna College with a degree in economics and a master's in finance. Started off my career at JP Morgan in the private bank, and I have my CFA and CFP designations. Today, I'm actually going to be mostly behind the scenes to coordinate the Q&A. And so on your personal screen, you're actually going to see that you have the ability to submit questions. So throughout the presentation, feel free to submit questions. We've also earmarked about 15 minutes after the presentation to answer any additional questions that you guys have. So if for whatever reason we don't get to your question, we'll just ask for your name and your email so that we can follow up with you after the presentation. All right, Jeff, back to you.
Thanks, Arya. I appreciate you speaking up there and letting people know about yourself. I'm going to go ahead and get started with our presentation today. We're going to talk about investments, and generally we're going to go over some key tenets that I think are really important that people need to understand when they're starting out in their investment lives. First, we're going to go over why people invest, and then over the various life stages that are involved on their journey. We're going to talk about what I think is the most important thing about investing early and often, and go through some of the building blocks of a portfolio, which are stocks and bonds generally. I'm going to show you some historical returns to put a lot of things into perspective. We're going to talk about different ways of investing and kind of the conventional thoughts that people typically have when they talk about investments. And then once I discuss those things, we're going to talk about, okay, we're ready to invest, and what type of accounts do I need? We'll go over different investment vehicles, like ETFs and mutual funds, talk about diversification, not just within the US, but also outside of the US, which is extremely important in this globalized economy. And then finish it off with kind of what we call kind of a catch-all investment vehicle. And then I'll share a couple of book recommendations so you can continue your learning and your education in investments, because I believe that everybody should have a firm foundation before they begin their journey. And it's always good to get backup information and key thought leaders on these subject matters. So first off, why do people invest? Well, it's mainly to allow you to accomplish your long-term goals and objectives. There's many on this list, but if you could think about it, one of the biggest things that people save for is purchasing a house. They might get married, they want to have kids. Want to save for their children's education. You maybe want to travel. May want to have some experiences. Travel all over the world. Well, that takes a lot of money, and it's important that you understand your financial capital and how to put it to work for you so that you can enjoy those things. And last but not least, retirement. I think that's the number one reason why we all invest. It's to make sure that we are set once we retire, so that we don't have to go back to work and struggle to stay afloat. So one of the reasons why we really need to take investing seriously is that wage growth and inflation over the last 20 years really haven't given you much in terms of a return on your money. In terms of growing your income, you can see by the purple line that it's been pretty choppy, but it's ranged from about 5% to negative 2.5%, but averaging about 2.5% over the last 20 years. And inflation has essentially done the same exact thing. So those two things cancel each other out. So you're really not getting any more increase in your wages to offset the increase in inflation. And really important to know is that your conventional ways of saving in your savings account and checking accounts really aren't going to cut it these days. Checking accounts are really, you're only earning about 0.01% right now, and the average savings rate is just a little bit above that. When inflation's 2-3%, that's not going to cut it. So one of the things is we got to understand what about investing and how do we invest smartly. I'm going to go through some various life stages. We're first going to talk about what the learner phase, and I think this is very important because it's your education and how you develop the skill set to earn as much money as you possibly can. Whether you go to college and you get an advanced degree and you work maybe as a doctor, that could take you up to age 25, 26 to finally get into your residency and start earning some wages. Or if you're right out of high school and you just start going into a vocation, maybe you go into the elevator union for that matter. Or there's lots of different things that you can do, but this is really important because it allows you to grow your income to a level that now you can start saving and affording certain things in life. Once you've gotten a job, or maybe you have multiple jobs that you're doing, this is where we start to accumulate our income and start saving. This is extremely important because as you develop your financial assets, you're going to need to start putting some of those things to work, whether it's in a retirement plan or you're saving on your own. As you move through your the accumulation phase and you start approaching retirement, that's when you start consolidating all of your assets, whether you own a business or say you're winding down your business and you want to sell it. Well, you need the money that you're going to receive from that business, you need to put it in a responsible investment portfolio so that once you do retirement, you can then spend from your portfolio. And the average age of retirement is about 65 to 67 years old. You do have a life expectancy in nowadays up to around 90, 95 years old, and some people will live to 100 or even longer with all the advances in medicine. But it's really important that once you get to your retirement age, you have enough in your financial accounts to sustain and support you throughout retirement. This is kind of a way to think about your ability to take risk as you age. When you're younger, you can have a more aggressive portfolio. If you have any losses from investments, you can recoup those losses because you have a long time horizon to earn those, to save back and contribute to your accounts. If you're older and in retirement, you're probably going to need to have a more conservative portfolio because you're going to be spending down that bucket of assets. It's really important to understand the difference between being young and being able to take risk and being a little bit older and understanding that your ability might not be as great. When you think about retirement, one thing that we always talk about is, in order to kind of keep your same level of standard of living, you actually need to probably replace about 75% of the income that you're currently making right now. So say you make $100,000, 75% of that, 75,000, is something that you can expect to be spending in retirement to sustain what you are currently living like in today. 25% of that we expect to kind of come from Social Security, but that's kind of up in question because the Social Security has some issues, and if you look at some of the studies, it's expected that Social Security will start running out by the time the year 2035. So there's going to need to be some changes made to that before it runs out, and so that's something that's questionable. And I highly recommend people don't count on Social Security to sustain them in retirement. The other 50% is going to come from what you save and the investments that you make. So in your 401k, in your IRAs, Roth IRAs, taxable accounts, etc. So it's important to understand that you're going to need to save a decent amount in order to have that same standard of living. So now we get to one of the most important aspects. It's investing early and often. This is a chart that shows the account growth of $200 invested and saved monthly. What I really want to point out on this chart is two people in particular. I want you to focus on the difference between Quincy and Quitter Quincy and late Lila. So Quincy and Lila, well, actually, let's start with Quincy first. He starts investing the $200 per month for 10 years, and he stops after 10 years, but he starts at age 25. I'll show you something real quick. Get my laser pointer. So he starts at age 25. He only invests $24,000, which is $200 monthly for 10 years. All right. And then he stops at the age of 35. He doesn't invest any more money. Then you have late Lila, who starts at 35, and she does this. She invests the $200 monthly for 30 years. And so she actually contributes a total of $72,000. But if you look at the difference in the terminal value or the ending value of these two people, they actually have a very similar outcome. Quincy, who started 10 years earlier but only invested for 10 years, whereas Lila invested for 30, they actually have a very similar outcome. 200,000 to 192. So this just shows you that the earlier you start, the better off you'll be. If Quincy had continued to invest for the next 30 years like Lila, he'd be up with Chloe up here, and have twice as much money that he had before. So this is just a really important point. Start investing early and have a diligent plan and stick to it, because you'll be rewarded in the long term.
Hey Jeff, before you move on to the next slide, we actually had a question that came in, and this kind of relates to that last chart that you were speaking to. So the question is now a good time to start investing, just given all of the uncertainty with coronavirus? So maybe, talking about the impact on the economy and the markets, and whether or not today is a good time to invest.
That's a great question. Look, I would say, considering that most of the people on this webinar are going to be a younger age, I would say it's a good time to invest. There is a lot of uncertainty in the market, but one of the great sayings that I've heard over the years was, the best day to invest was yesterday, the next best is today, and the next after that is tomorrow. So don't get caught up in what's going on in the economy. You hear everything going on with the coronavirus, and the economy has been tanking, and unemployment has been up. But if you look back into March 23rd is actually when the stock market bottomed. We've since rallied about 36% since, and there's a couple indices that track the U.S. markets. They're actually positive on the year. So a lot of people who were worried and panicking, they may have sold out during that time period, but they needed to get back in the market in order to get that bounce back. So it's really hard to time the markets, and I don't advise it. But I would say that with a long time horizon, and when you're contributing monthly, you don't need to worry about so much the volatility of the market, because you're going to be what we call dollar cost averaging into the market, and so that reduces your risk as you're entering the market. Now, if you have $50,000 and that's your life savings, and you want to put it in the market all at once, that's okay. However, during times of volatility and increased uncertainty, it's one of the best strategies is, especially for your own psyche and emotional thoughts behind your money, is to just slowly creep into the market until you start getting a feeling and an understanding and a kind of a calm about the markets and what they've been doing. Over the last couple of months, we've seen a ferocious recovery, and a lot of people panicked, and they didn't get back into the market, so they missed out on a huge rally. So I hope that answers your question pretty well, and move on to the next slides. So this is kind of a cool little chart. I wanted to show you how you can build $1 million in 27 years, depending on what income you have. So this chart shows a percentage of weekly or of bi-weekly paychecks for a 40-year-old that they would need to set aside to build $1 million if they were going to earn a 6% return compounded monthly and they retired at 67. So as you can see, you have a person who's earning $40,000, they're going to need to save close to 37% of their money and invest it at a 6% return. When you get closer to say 100,000, it goes down quite substantially. It's only 15%. And you think, oh, 15%, that seems like a lot, and it might be, but when you're young, anything that you can start saving with is extremely important. So whether it's $50 a month or $100 a month, if you can start getting to weekly savings, bi-weekly savings, it'll add up. And once you start earning a decent income, that habit, that discipline of contributing to your retirement accounts and your taxable accounts, you'll have that habit in place, and this won't seem as daunting, but it is extremely possible. And especially if you start young, you can definitely have $1 million portfolio in 27 years. So next, what I want to do is I want to talk about what is the stock market and the bond market for that matter. And I'll start with a bigger kind of picture of what capital markets are. So capital markets, it's where firms come to fund their operations, governments to borrow money so that they can provide services, goods and services to the people of their country. But for the most part, when we talk about the difference between stocks and bonds, we're actually talking about the ownership structure. And I'll start with bonds because this is kind of it's easier to understand. I think we all kind of understand the difference between what a loan is and actually stock ownership. But with bonds, you're loaning money to a corporation or government for that matter, and they're going to pay you interest on that loan. Okay, you don't own necessarily a piece of the company, but you're receiving your interest on the loan. So maybe you bought a bond or the company issued bonds at 5% coupon interest. So you're going to receive 5% on each interest payment, and then at the end of the term of the loan, you're going to receive what we call your principal back. So if it was $10,000 that you loaned and you're receiving 5% on that each year, you'll receive that $10,000 at the end of the loan. Granted that they don't go bankrupt or some other matters. With the stock, with ownership, the company is going to raise capital that they're going to use for funding their operations. And so what they'll do is they'll issue shares, ownership of the corporation itself. And so when you think about it this way, you actually own a piece of the company. You have voting rights. You can, there are annual meetings where the corporation will ask if there's anything that investors want to bring to the forefront of the board of directors, et cetera. And that's a little bit advanced, but we don't need to get into that. But just understand the difference between bonds and stocks. A bond, you're lending money, and with stock, you actually are owning part of the company. So that brings me into what the building blocks of portfolio are. We're going to talk about bonds in terms of what they really stand for, and then we're going to talk about equities or stocks. So fixed income is what we talk about when we talk about bonds. It's really kind of an income and safety portion for your portfolio. It's tends to have a shorter time horizon, if you have a shorter time horizon, this is going to be more appropriate for you because it has a little bit of lower risk and lower expected return from it. Certain types of bonds or treasury bonds, municipalities like the city of San Diego might issue bonds to redevelop some parks or some services like that. And then you got corporate bonds like say Apple. They issue some bonds. They want to fund something. They want to build a new campus or whatnot. So these types of this type of investment tends to be more safe, and it's more for the kind of a staple of the portfolio. And then we'll talk about stocks here. So stocks are more for long-term growth and appreciation. It is definitely for people with longer time horizons, and they come with a lot of risk. But you tend to be compensated for that higher risk. When people come to the capital markets, they're expecting a return on their investment, and so when a company issues stock, people are going to buy those shares of the company because they expect something in return. It might be a huge growth opportunity for a certain type of company in a certain type of market. When we talk about stocks, we want to understand that you need to have a long enough time horizon to hold that stock, because there could be a lot of volatility. You never know what's going to happen in the marketplace. There could be a competitor that comes into the market and has a cheaper product, a more valuable product that consumers like, and so there could be opportunities for multiple people or entrants into these markets, and if you don't have a long time horizon, you might be thinking that if the stock went down and it continues to go down, you might think it's a bad investment and sell and potentially sell at the wrong time. So we advise to have a longer time horizon, and I would say the optimal time horizon is 10 plus years, minimum 5 to 10 at the least. So now let's talk about some historical returns. These returns that we have on the table go from 1973 to the end of last year, about 47 years of data. And I really want to focus on the growth of $10,000. So if you had invested $10,000, in the markets, and there's various asset classes here that are represented, but inflation alone would have, $10,000 would have turned into $60,000. Okay, so that means that you had, potentially what cost $10,000 back then costs $60,000 now. So inflation is important. We need to take that into consideration. Treasury bills from the U.S. government, they've returned a little bit more than inflation. Okay, they have low volatility, and I'll explain the standard deviation here in a second. This is kind of what we mean about volatility. But the returns that you get from holding more risky assets, more intermediate bonds, longer term maturities, U.S. large cap stocks. That's there's over 300 or 3,000 U.S. stocks in the market, but there's what we call the S&P 500 is a major index, and that represents the 500 largest stocks in the U.S. economy. And over that time horizon, they've returned 10.5% per year. So that $10,000, if you would have kept invested for that 47 years, would have turned into a little over 1 million. Then you have small cap stocks. They've returned a little bit more. And I think the easiest way to understand this is that large companies can't grow forever. But small companies can grow pretty quickly, and they tend to have a potentially higher return because they can grow into some of their valuations. They start off as small stocks, and then they can turn into large stocks. But one thing that I like to consider is that there's what we call the law of large numbers, that something can't continue to grow at an exponential rate because it'll get too big. I think we all can understand that, like Apple stock, the company right now is actually worth the market cap of about $1.9 trillion. What's the likelihood of that doubling, turning into almost $4 trillion, over the next few years? Well, small companies that are maybe valued at a few $1 billion, they have the chance to double in a lot shorter period of time, and so that's something to consider. There's definitely opportunities there. Also in foreign stocks, that has a little bit less return, but that turned into 400,000. And then you have real estate, real estate securities, what we call REITs. These are investment corporations that own property across the country. They get rents paid to them, and they have owned a diversified pool of these real estate assets. And so if we look at the standard deviation down here, this is what we call the variability of returns. And the higher the standard deviation, the more risk, the more volatility, as a stock might move up and down. That standard deviation captures this this choppy movement. And so we can see that small stocks and foreign stocks have a higher standard deviation, as well as real estate and large cap stocks. So one thing that we all got to understand is that investing can be scary. If you look back to the financial crisis of 2008, you had all these articles in the Wall Street Journal, news magazines. There's all sorts of images out there saying that death of equities. Investing is never going to be the same. Can the U.S. economy recover? I'm here to explain to you that, yeah, it can be scary, and that's why a lot of people don't invest, or they're just afraid to. They don't know how. But that's the wrong way to look at it. Investing shouldn't be super scary. As long as you have a disciplined plan, you can actually be rewarded substantially in the markets. And this is a chart that shows the up and downs. But it can be extremely rewarding to patient investors. So back in '96, this is I think a 24 year chart. There was about 106% return to the top in 2000 with the .com bubble. Then we had a crash of about 49% over the next 2.5 years or so. Then we gained another 100%, only to fall another 57% with the financial crisis of 2008 and 9. Well, if you were a worried investor and you panicked and you sold out during these downtimes, the problem with selling out of the market is that in order to earn a decent return, you need to be patient and you need to stay invested. The people who bailed here, I guarantee you they didn't get back into the market down here. They were afraid. They didn't think anything was going to change. And if you look at these time periods, you'll understand that the market bottomed way before the economy did. The economy and the markets are not necessarily the same thing. The stock market is kind of a forward indicator, and it looks out into the future about 6 to 12, 18 months ahead of time. And so at this point, back in 08 and 09, you had a bevy of information that looked like it was one of the worst recessions. They called it the Great Recession. It could have been worse than the Depression. But the federal government, the Federal Reserve stepped in and they kind of backstopped the economy and made some efforts to put confidence into the market. And since then, has been a 400% increase in the S&P 500, the 500 largest companies in the United States. And if you look back to February 19th, which was our peak, then we had the coronavirus, and we had a sharp decline of about 33% or so, and then we bounced back. These bounce backs are so quick and so abrupt that in order to think that you can time these markets and get out and then get back in, you've missed the opportunity. So this is just one thing to understand, that it's very difficult. And so what I would advise is, if you were invested at the very beginning, that you stay the course. You have a discipline plan in place. And when you're young and you can afford to take risk, when these downturns happen, this is a great time to put more money to work. You can make exceptional returns. And when I first started out in the industry, it was about in 2007, and I saw this decline. And honestly, anytime I see the market go down 20, 25%, I get excited, because then I could put more money to work in the market. I'm already dollar cost averaging into the market as it is with my retirement accounts, but any excess cash that I have, I'm looking to put to work when these things happen. It's a great opportunity for long-term investors, and that's why you got to stick with a good plan.
Hey Jeff, so we just had a question that came in, and the question is, actually, Jeff, do you mind putting yourself on mute for a second? I think there's just a little bit of feedback. Okay, so the question is, would it be smart to cut your losses and sell your stocks when the market is down so you can buy cheaper stocks? And so I think there is maybe an opportunity to talk about maybe behavioral finance, as well as maybe tax loss harvesting opportunities as well there.
Sure, that's a great question. And I will say that it is extremely difficult to see ahead of time when markets are going to decline. It could have been easy, and some people have done it when they heard about the pandemic starting to come to fruition in February and March, to sell and get out of the market. But like I said, the markets tend to move very quickly to new information as it comes in, and if you think that you have the ability to say sell and have the patience and the strength, the mental fortitude to get back into the market when things are still extremely negative in the press and the media, you're kind of kidding yourself. We saw more volatility in the month of March where the markets were down 5, 6, 7, 8%, and then they were up 5, 6, 10%. So we had so much volatility in that time period, and things just kept getting worse and worse and worse. And into the months of April and even May, the data just kept on getting worse and worse. And I think at one point the economy, I think in the second quarter, contracted about 32% or so. Well, that's what the market contracted in the month of March. But it's since recovered, and that data hasn't come back and hasn't really gotten any better. But what the market is kind of sending here is that there's expectations that things are going to get better in the future, and who knows when. I wouldn't have been able to call the bottom on March 23rd, and I don't think anybody else has that ability to. And anyone who tells you that they have the ability to do that, I would say I'd run away as far as possible, because nobody is that good at predicting the future. So the market is a collective opinion of every investor that contracts with stocks and bonds, or transactions stocks and bonds. So I don't recommend trying to time the market, but I do recommend dollar cost averaging into the market. And like I said, whenever you see a big downturn in the market, 20, 30%, that's a great time to put some money to work. Another thing that you mentioned, Arya, was tax loss harvesting. So this is an important concept that we use for clients who have taxable assets. So they may have a trust account or an individual account, and when the market's going down, your portfolio of risk assets, say U.S. large cap stocks, go down 30%. Well, what we do during this time period is what we're doing is selling those stocks, and we're actually rebalancing portfolios. So we may have a client has a 60-40 portfolio, meaning 60% in equities and 40% in more safe bonds, high quality fixed income. And what we'll do is we'll sell those equities at a loss, and we'll actually buy back in. We'll sell some fixed income as well, and we'll buy very similar assets in equities to capture the loss, but also stay invested. And so I guess you could think of it as, you might be down 20%. We might sell it, but we're buying something back with the same dollar amount. We're capturing that tax loss that you can carry forward to offset any capital gains in the future. But we're actually also adding some extra money into the market by selling bonds and buying equities. And then when the market recovers, you have what's called a tax asset, as well as you have the gains on those assets that you purchased. And so you actually never got out of the market, but you've captured a loss that's just extremely valuable as you go into the future, especially if you have other assets that you plan to sell and have a capital gain. So you can use that loss to offset any capital gains that you might have from your portfolio or outside of your portfolio. That was a great question. All right, so this is just a fun little chart that shows you the monthly growth of wealth of $1 invested starting in 1926 to 2019 with various asset classes. Like I said before, small cap stocks, they have actually returned a little bit more on an annualized basis. than large cap and long-term bonds and treasuries and inflation. But if you understand, $1 invested in 1926 would be, you know, almost $9,000 if you invested in U.S. large cap, or it'd be about $25,000 in U.S. small cap stocks. So just imagine if you had, you know, say, you know, $1,000, that could have turned into $25 million. It's extremely powerful. Capital markets reward long-term investors that have the patience and the knowledge and fortitude to stay invested over long periods of times and not get carried away emotionally when they see things in the news that make them want to sell. So, you know, there's kind of an interesting thing that we see all the time in the markets, and you might experience this from talking with friends and family, and you know, how people invest their own money. You know, you might hear some people say that they bet, you know, they have a new trick or tip that they heard, some hunches that they've got from some friends. You know, I heard it in the news. You know, oh, this company's going down the drains, I better sell. Or, you know, everyone's making money, I want a piece of the action. Yeah, I got a hot tip from my neighbor. You know, I want to invest all my money in this one stock because I know it's going to go through the roof. You know, or my friend works in the industry and he's got this inside scoop. Well, there's also other people that think that they know what's going to happen in the future. You know, they got this crystal ball and they always know what's going to happen. Well, you know, they say they have a proven track record or a proven system for picking individual stocks. That, you know, that sector is going to continue advancing through the next year. Think about, you know, maybe 3D printing or stem cell stocks, you know, that people got really hyped up on, that type of stuff. But I'll tell you what, it's extremely difficult to predict the future. And so when anybody says that they have foresight into a particular industry or category, I'm always kind of weary of that information unless I have data to back it up. So, you know, the conventional approach is these people, you know, they try to attempt to outguess the market. You know, they have all these stocks out there. You know, the market comprised of, you know, over, you know, say 5,000 stocks, and they think that they're going to be able to buy the ones that they expect to outperform, and that they're going to be able to sell the ones that they think are, you know, overvalued. But, you know, what this actually leads to is, you know, high turnover and excess cost. They're trading a lot. You know, they may recognize short-term gains, and if you've listened to the previous webinar on taxes, you'll understand that short-term gains get taxed at ordinary tax rates. They're it's a disadvantage for you to sell before owning for that asset for over a year. Once it gets over a year, you have long-term capital gains, which is at a much lower tax rate. So, you know, this can just lead to you know, extra cost, and, you know, when you're paying taxes on your investments every year, you're not allowing that money to grow and compound over time. And that's one of the most important concepts about investing is reducing tax, reducing your turnover, so that you can allow your money to grow for you, you know, at a longer period of time, and that you have more money to grow. So, you know, one of the things I like to think about in markets is kind of like, you know, in a traffic jam. You know, you're, you know, in rush hour traffic, and you see the lane on your left and it's going fast, and you're like, oh, I'm going to get in that lane, it's going to go a lot faster. And then all of a sudden you come to a standstill, and then you see the lane that you were just in, and it's going by at a much faster pace. And so you get over into that lane, and next thing you know, you're at a standstill, and then the lane that you just left was, you know, it starts moving again. And so you're going back and forth trying to change all these lanes. Well, think about it, the same thing as investing. You know, this can lead to a lot of frustration, road rage, actually, and anxiety, and taking unnecessary risk, and could lead to an accident on the roads. Well, it's the same thing with investing. You know, this can lead to you taking unnecessary risks, overtrading your portfolio, you know, just trying to jump on the next bandwagon or trend after that market has said already popped. So just understand that, you know, staying in your lane, knowing that you have a strategy that you've put in place, that you're going to continue to save and invest in a certain way. We'll get to the what I believe is the right way to invest in a little bit, but that's one of the most important concepts, is really understanding that you need to not move in and out of the markets, because you're never going to time it right, and that can just lead to a lot of frustration and headache over time. So, this is a great graph here, charts that show that, you think you can beat the market. Well, I'll tell you what, I would say think again. If you look at the left, the United States, this is advisors, funds, large cap funds that have underperformed the S&P 500 over the last 1 year, 3 year, and 5 year. You have 70% and 80% of the funds have failed to outperform the S&P 500. That's a very, it's a poor success rate, that only 20% of the large cap funds that are actively trying to beat the market actually do. So, and then if you look into Europe, it's kind of the same picture. In Japan, it's a little bit better, but you get the general gist. It's extremely hard to beat the market over these periods of time. So I suggest not trying. Let the markets kind of work for you. Invest in index funds that track those indices like the S&P 500, and do it at the cheapest way possible. So when I was referring to moving in and out of the lanes on the freeway, this is what I kind of getting at. When you react to the markets, it can really hurt you. And this chart just shows the difference in returns if you were to miss the single best day in the market, 5 best days in the market, 15, 25, etc. So you can see that, from 1990 to 2018, that the market, the S&P 500 returned 9.29% annualized. Okay, if you miss one day, it goes down. It looks like it's not a whole lot, maybe 50 basis points, and a basis point is 0.01%, but that cuts your return down by almost $1,400 on $1,000, and it just continuously erodes the potential of returns. And so that's what I mean by not changing lanes and not getting in and out of the market, because I guarantee you're going to miss some of these great days. And especially, back if you look into coronavirus, back in March when the markets were very volatile, those are some of the biggest days, and it can really hurt if you sell out when the market's down 10% one day, and the next day it pops 12%. That's, you immediately lost a decent return there. So here are some kind of key tenets to live by, which I believe will provide you the best way of ensuring success while investing in the markets. I'd say control what you can control. Your risk, the amount of diversification you have, taxes, cost, and let the markets do the rest. So save as much as you can. The earlier the better. Spend less that you earn. Control your costs. I think Hope went over it earlier in a previous webinar about budgeting. If you can budget successfully and pay yourself first with saving and investing in yourself and your portfolio, you'll be much better off in the long term. Trying to time the markets, it's really a losing proposition. It's extremely difficult. Not only do you need to be right when you get out of the market, you got to be able to get back in. So you have to be right twice. So that's 2 times the amount of decision making that you need to make in order to successfully do that. And I'll tell you right now, if you talk to any financial advisor or anybody, reputable source, they'll say that timing the market is extremely difficult, and they advise against it. Control your risk by holding broadly diversified portfolios. The S&P 500 is a great example. It's 500 companies, the largest companies in the United States. That is a diversified pool of investments. You own 500 stocks if you buy an S&P 500 index fund. If you own only a couple of individual stocks, you have a lot of concentrated risk in those individual stocks. And so I think I'm sure you probably have heard of this guy, Jim Cramer. He has a segment on a show called "Are You Diversified?" and people call in and they say they name their 5 stocks, and he says whether they're diversified or not. Well, studies have shown that you actually need to hold close to 50 stocks in order to have any sense of diversification in that way. So I would advise against the 5 stock idea that Jim Cramer has. But his show is entertaining, and it's one of those things that every once in a while I kind of enjoy watching, just because it's he's kind of a little crazy, but it's probably because he has a producer in the background who knows how to do that entertainment value with that type of storyline. Another thing is we got to keep turnover low. So trading activity, we don't want to buy and sell stocks like I mentioned all the time. Once you buy something, hold it. And avoid the unnecessary taxes that go along with it. So one of the strategies that you can employ is a tax loss harvesting strategy. If you do sell something at a loss, buy something very similar back at the same time, so you capture the loss but you stay invested. That is the key to a long-term successful financial investing career. And minimize the extra costs. So those are the fees that you may be charged on some of the funds that you might use, whether it's ETFs or mutual funds. There's a management fee for those investment solutions, and I would highly recommend that you try to avoid the more expensive ones. They tend to be more active. We want to stay a little bit more passive and have a more indexed approach. So owning some individual ETFs that focus on the S&P 500 or the Russell 2000, which is a small cap index, those are good types of investments to make. So now that we've talked about investments, let's talk about the types of accounts that you can use. So certain retirement accounts that are tax deferred are 401ks, IRAs, contributory IRAs. These are the limits for 2020, the year 2020. Then we have Roth 401ks and Roth IRAs. These are after-tax accounts. So you essentially are taxed upfront, with your earnings and income and stuff like that. You can contribute to these Roth IRAs, and you will never be taxed on the withdrawal of those earnings. So I highly recommend that the younger you are, the more you contribute to these Roth IRAs and the Roth 401ks. If you work for a company and they have a Roth 401k option, highly recommend that you use that option while your taxes are low. As you age and get older with, as you earn more income, there's phase out limits for these. So, I would take advantage of these as soon as possible. Then you have your taxable accounts. You have your individual brokerage account, joint tenant account, community property, and trust accounts. We won't get into these really, but this is where any after-tax money that you want to put and grow and be able to withdraw at any time. These are the accounts that you should start focusing on. Then we have college 529 plans. These are for higher education expenses. The money that you put into this grows tax deferred, and the withdrawals can be tax exempt if they qualify for higher education expenses. So this makes these types of accounts extremely valuable, especially if you plan on going to college, or having a postdoctorate degree of some sort. And these can transfer to siblings or other people. So there's some transferability in those things. It's extremely important that everybody understands these types of accounts. So now let's talk about diversification. So we're talking about 3 stocks here. So we got security A, B, and C. They all move in different directions. They're choppy and whatnot. But if you were to put these all together, and you'll see that there actually is less volatility in the basket of these 3. So think about it this way: you have more stocks, you have more diversification, and less of a bumpy ride rather than having holding one individual stock. So some solutions that come to mind, we talked about a little bit of ETFs and mutual funds. So ETFs, these are great. They can be broad market based, or they can be sector specific. I think about Vanguard and it's a great company. They're kind of been the pioneer with the index funds, and they have sector ETFs along the 11 sectors of the S&P 500, but they also have a broad S&P 500 index. So, rather than buying the individual sectors at the weights that the S&P 500 is, you can just buy the broad S&P 500 index. These are typically really low cost. There's no investment minimums, and they trade daily. And then you have mutual funds, same exact concept. They could be, they're broad market, sector specific. They can even be multi-asset class, large stocks, small stocks, foreign stocks, kind of, can run the gambit. But one thing to understand is that these trade at the end of the day based on the net asset value of all the stocks in the portfolio. So they don't have the price volatility that an ETF does during the day, but they trade at the very end of the day. And they can be a little bit more expensive, but there are some mutual fund companies that have low mutual fund costs, like a Vanguard or Dimensional Fund Advisors. So when we talk about S&P 500, one of the biggest things is the cost of these funds. So the Vanguard S&P 500 index, it has a 0.04% cost on that basket of stocks. And as you can see on the right here, you have, these are just the 10 largest companies in the portfolio as of April. So, you're getting 500 of the U.S. companies on one portfolio for an extremely low cost. I can't stress this enough. There's other fund companies out there that'll have a 500 S&P 500 fund that might have be charging 0.8%, 0.5%, and it might be instead of it being a blend of just owning the index itself, they might say, oh, we're a growth index or a growth fund. We weight these stocks a little bit differently, or we're a value fund and we weight these a little bit more differently, but they'll charge a higher fee because maybe they're trying to beat the market a little bit. I advise against it, especially when you're starting out. The idea is that you start investing young, and so instead of trying to pick individual stocks, just buy a basket of stocks like the S&P 500, the Russell 2000, or other funds like that. And when it comes to the world of investing, there's a huge opportunity out there. The S&P 500 is just one index, but U.S. stocks, according to the world market capitalization, is only 54% of the total market cap of all equities in the world. There's a ton of other markets out there, and it's important that we get some broad diversification. So owning some international funds that have exposure to Japan, United Kingdom, France, Germany, even China for a little bit there. But these are the ones in blue are developed markets. They're a little less risky. Emerging markets are the ones in gray. Those are a little bit more risky. And then you have frontier markets, which are extremely risky. There's not a whole lot of regulations and stuff like that. So I would focus on the developed markets and in even having some emerging market exposure, because they have a little bit higher expected growth rates, but they come with a lot more volatility, which is risk that you're adding to the portfolio. Now, this is the one thing that I kind of recommend for people who are just starting out with, like, say, a 401k. You'll have some investment options. But one of the key changes that was made over the last few years is what we call target date funds. It's one fund, and it has a target date of your anticipated retirement year. It's invested across multiple asset classes, equities and fixed income, and that allocation will change over time as you age. If we look back to the first or second slide that I showed with the investor stages, as you progress in age, your ability to take risk gets lower and lower as you approach retirement, because you need those assets to provide income in retirement. So you might be more aggressive in the earlier years in life, but you might be a little bit more conservative as you get older. And so these types of funds actually do the work for you. I'll show you an example of what I mean. So as you can see, when you're young and you got 45 years till retirement, the equities can be upwards to 90% of the portfolio. Okay, you got your U.S. stocks in red and international stocks in yellow here. And as you approach your retirement, pre-retirement years, the fund is going to gradually get more conservative until you approach and hit your retirement date. And so after this point, your equities essentially almost been cut in half, and now you have more more safe assets in there, but you still have some risk for growth of the portfolio. But what this type of fund does is it hits the 4 key tenets that we talked about earlier about risk, diversification, tax, and cost. These can be extremely cheap funds to use. And so I recommend these for anyone who's starting out that doesn't want to spend a whole lot of time, researching different funds and stuff like that. This is a extremely valuable investment vehicle to use. And this is just an example of one of the retirement funds. It's the 2055 retirement fund. It's composed of the Vanguard total stock market. So this is kind of U.S. Total stocks, both large, small, and mid-cap stocks. Then you have an international stock index, followed by 2 bond funds, a U.S. total bond market, and an international bond index. And so, as you can see, it's about 90% in equities and 10% in bonds, and that would, over time, get more conservative. And this fund is only 0.15%. So it's a very low fee to access a great investment tool, a vehicle that will provide everything that you need. So it's kind of a set and forget. And the only goal that you have is to continue to save and put money into this fund as you grow older. So I think that wraps it up. But what I wanted to recommend here is a few books that I find pretty valuable. The Intelligent Investor by Benjamin Graham. He's known as the father of value investing. I'm sure y'all have all heard of Warren Buffett. He was a student of his, and he was employed by Benjamin Graham when he was 20. So he learned a great deal from this guy. And so he wrote a very good book called The Intelligent Investor. It just gives you a good idea of what things you need to know when you start investing and start learning about the markets. Next one, a random walk down Wall Street. It's a great one. It really tells you that the market is it kind of is a windy road, and it goes up and down, and just gives you a perspective that I think is extremely valuable. Another book, the little book of Common Sense Investing by John Bogle. He's the founder of the Vanguard Group. I think he was the one who created the first index fund, which of the S&P 500. So he's credited with that. Extremely successful. He's built an empire that has really been aimed at helping the little investors access the markets in the cheapest way possible. So I highly recommend those. And then you got these other 2 books that are also very good. So these are some recommended readings that I would suggest, but I would say continue to educate yourself. You can also look into the CFA Institute. That is the organization that both Arya and I have passed the exams to get that credential as CFA, as well as the CFP, Certified Financial Planners. So that ends our presentation, and I'll pass it along to Arya for some Q&A.
Thanks, Jeff. So we actually only have one question that came in. And so the question is a little bit of a more topical question. And the question is, what are your thoughts on Eastman Kodak?
Oh, that's a great question. So Eastman Kodak, for those of you that don't know, it is, well, I think probably a lot of you do know that it used to be, or it is a film company. They used to be in the Dow Jones Industrial Average, one of the, a big company back in the days, and they didn't really get into the digital printing process, so they kind of fell to the wayside, and they almost declared bankruptcy in 2012. But just a couple weeks ago, the Trump administration, said that they were going to give them a loan of about $765 million to start developing pharmaceutical ingredients to help with fighting the COVID virus. And so news leaked out that they were going to do that, and the stock went from, I believe, $2 or $4 a share up to $60 within the day. And a lot of people wanted to get in. I mean, even my mother-in-law wanted to buy the stock, and by the time she wanted to do that, it was already at $50 a share. Fast forward to today, that stock is now down to $10. So anybody who tried to invest in that stock most likely got slaughtered. It was extremely volatile, and now they're actually being investigated by the SEC for potentially leaking that information before they release it to the public. So what this is an example of is that markets will move extremely fast, and by the time you want to get into something, the price is already baked into the stock. And then you might have some aftermath, and stocks tend to jump real quick, and then they might trickle back down. News travels quickly, so I would suggest that you stay away from these types of companies. It's all news and hype and speculation. There's much better tools out there to build wealth. There's this kind of idea that fast money that you can make in the stock market, and it's very tempting to follow that idea and to research these companies that are on the cutting edge of X, Y, and Z, or AI technology, or any vaccines or whatever, you name it. There's tons of things out there, but by the time you hear about these companies, they have already been, the price is already adjusted. It's already moved too quick, and by the time you get in, you're getting in after everybody's already gotten in. So I highly suggest against that, and I have personal experience of trying to buy individual stocks a lot for myself, and I've missed out on just having an indexed portfolio that would have been consistently growing over time. And I've tried to do those things, and I know that it doesn't work. I'm a living example that it is more important to stick to the disciplines of saving, cutting your spending, and contributing to a basket of stocks, like an index fund, ETF, or mutual fund, and just continuing to attribute to that, because over long periods of time, you'll be rewarded. There's many times when you'll try to get into a stock and it's too late, and the floor will drop out from underneath you. Anything else?
You know what? We actually do have one more question, because there was one that you kind of talked about already, and that was speaking to ETFs and mutual funds and how that's a good vehicle for somebody who's just getting started out with investments. But with regard to the Vanguard 500, the question is, do you think the Vanguard 500 is the best ETF to invest in? And so maybe this is related to, kind of that slide that you spoke to about, the worldwide basket of securities that you could invest in, and there's domestic stocks and international. Maybe you can touch on that again.
Sure, absolutely. So the reason why I mentioned the S&P 500 is because it's one of the most widely known indices out there. A lot of companies tried to build their own mutual funds or ETFs that track that index. It's extremely transparent, so what's in that portfolio of stocks. That's something that I would recommend for everybody. Just own a piece of the U.S. large cap market. It is a solid, it's a cheap way to access the markets. But I would also recommend, some smaller indices to invest in, like the Russell 2000. Russell Investments Group, they have a bunch of different indices, and honestly, there's hundreds, if not thousands, of indices out there, and so you can get caught up in a lot of noise. But there's really, I would say, just focus on three maybe. The S&P 500 is one of them. The Russell 2000 is another one. It's the 2,000 smallest companies in the United States. And then there's, I would say the Vanguard Total International Equity Portfolio. It invests across all the international markets, and it includes emerging markets in there. It's a cheap way to access an extremely diversified portfolio of stocks. And if you combine those three types of indices or ETFs or mutual funds in that order, maybe have a little bit more in U.S. than foreign, since we live in the U.S. and everything kind of gets translated back into U.S. dollars. But I would highly recommend that you have some exposure to international stocks and also maybe even real estate securities. And so, I'm not talking about buying a piece of real estate like an investment property. I'm talking about buying what we call REITs, which are real estate investment trusts, and those trade on the open market. You can buy ETFs or mutual funds that track the REIT indices. They're extremely, Vanguard's got a few of them. I'll say Russell has some products as well, even BlackRock. But they're cheap ways to access those markets. And with REITs, you tend to get it's a diversifying effect. So it's not correlated with the different types of equity markets. Yeah, they might move a little bit together, but they have some diversifying effects because they're not fully correlated. But those REITs actually they're special in that they distribute more of the income. I think they have to, by law, distribute 90% of the income that those properties generate to the investors, so that they avoid some of the tax issues with owning with the fund company owning those different types of stocks, so that they don't get taxed in the fund itself, and that it transfers over to the individual investor. And that's a little bit more complicated to understand and interpret, but there is some benefits to owning REITs as well.
Thanks, Jeff. And that's actually it for all the questions.
Awesome. Well, I want to end with just kind of two little thoughts that they're kind of interesting that I have lived by. When it comes to understanding investments, you can kind of think of it maybe as like a nice diet and exercise program. So the saying goes like Rome wasn't built in a day, but they were laying bricks every hour. So you're not going to lose that 20 pounds and gain 5 pounds of muscle overnight, and you're not going to become a millionaire overnight by investing. You're going to need to do small, disciplined steps and try to contribute as much as you can, and over long periods of time, your financial portfolio will get in shape just as you would with a good diet and exercise program. So something to think about and ponder over. But thank you. I appreciate you guys checking us out, and I think you can find this video on YouTube after we post it, and as well on our website. So thank you, Aria. Have a great day.